Hey traders, welcome to the Charts and Coffee Show. Hope everyone is doing great. Got a little oh, hang on. All right, there we go. I think we're all running in the free trading room and on the Simpler Trading YouTube. All right, we're good to go. Excellent, excellent, excellent. All right. Okay, gang. So we have a busy week. If you take a look at the economic calendar, we did this on Sunday. And as well as in yesterday's show, we have a really busy week. And that means we have high impact, high volatility data and macroeconomic pillars that are in play. What does that mean? We have jobs data. We have the ISM data, which we could categorize with the inflation. We have Powell. We have a lot coming at us. And that means the market's going to have to digest new and interesting things. And what that ultimately means, and it's uncanny how often when we have weeks like this, we're expecting jobs data. We've got JOLT and non-farm payroll. We have ISM manufacturing and services amongst a myriad of other, we have the FOMC, again, don't want to ignore that. But really, I would say the FOMC is sort of a foregone conclusion. We're going to get that likely 3/4 of a point hike. Whatever the market is anticipating, and so let me show you here really quick. Because there's some chatter about, well, Rog, is the market going to be up? The market, are equities going to be upset about the hike? We're only upset about things we don't know are coming, right? So we're always measuring not whether or not we're going to be happy or sad about a economic release, but what do we anticipate is coming? If you take a look at the CME FedWatch tool, and where is it? Take a look at the CME FedWatch tool, and hopefully it's coming up. There we go. And you take a look at that November 2 meeting, tomorrow's meeting. Where is the probability? It's over 80% for 375 to 400. That doesn't mean we're going to see that many points of a hike. That means that is where the target rate is going to be. All right, well, let's go on over to Forex Factory and scroll on down to Wednesday and ask ourselves, well, where are we expecting rates to be? Right? There's your 3/4 of a point bump right there. Is this baked in? Is this expected? Absolutely. The messaging for the press conference is obviously going to affect expectation. So always remember, messaging is something separate from the statement and from the actual rate hike itself. What is Powell going to say when unleashed on the mic, right? But if we're already in alignment with this means that it's already been discounted. If that expectation for the rate hike is sitting on the Fed fund futures right now, and equities are moving up right now, we're okay with it. That's just the bottom line. We're okay with it. And really, it's not a matter of whether or not they're going to hike. That's a given. The bigger question is, when are they going to stop? And then where are they going to stop? So when are they going to stop? Meaning, what month is going to be that month where we finally get that last hike and then we plateau? And at what target rate is that going to be? And it continues to be somewhere between 4 3/4, 5% to 5% to 5 1/4. That seems to be where the highest expectation continues to be reflected in the Fed fund futures. Again, are these surprising? Are these things we've seen coming for a while? That's the measuring stick. So I hope that makes sense. That's the best way to make heads or tails of this event, and not start to speculate on lower probability, if not improbable outcomes. Because look, television, news, analysts, they're going to want to do that because they want to grab your attention. We're going to talk about the boring stuff here. We're going to talk about what is the market already calibrated to. There are ways to measure it, and that's the way you do it. All right, so that is what I definitely wanted to make sure we discuss to kick off the morning. And also, reminder that tomorrow night, just not too long from now, we're going to be having, about 36 hours from now, we're going to be having webinar number 2 for our decoding volume class. All right, last week, I talked a lot about daily timeframes and weekly timeframes. I talked a lot about 08 and 2019 and 2020, and how the beginning of this year definitely got me, I was shook, right? What's happening? The trades of 2020 and 2021, the tactics, the tools, things started not to work. And I know a lot of you experienced that as well. So we persisted with a lot of the trend following, which for the first few months of the year, if you take a look at where the S&P was earlier this year, gang, there was still some decent structure. It was just heading down. Uptrend, downtrend, I don't care. I know you don't care. As long as we have some follow through. We did have follow through, violent, but we had follow through earlier in the year. And then by the time we got to June, things started to get very choppy, really choppy. A little bit of weakness, a little bit of strength, a little bit of weakness, and things really got tough. And it's mid-year that I got frustrated. A lot of traders got frustrated. We didn't persist in pushing our agenda on the daily time frame, looking for swing trades. We said, you know what? How do we adjust? How do we adjust? And then in the interim of the last, this is October now, so 10 months, Lauren and I said, look, there's got to be something we can do that is going to allow us to deal with volatility like this, if this is here to stay. And we started going back to volume. And it's amazing how when trading is easy, we start to forget about our good old friends like volume. And we start to forget that, oh yeah, markets were pretty easy for a bit. What do I need to do to decode the current environment? So we went through a lot of testing for the last bit of 10 months. And that testing, as well as things that I've been doing for the last 20, 30 years, is the culmination of what we'll be talking about on Saturday. But what are we doing in the meanwhile? And what do I encourage everybody to do? Short-term trade. And that is what we're going to talk about tomorrow. Talk about short-term trading. Talk about day trading. 1 hour a day, gang. And I don't say 1 hour a day as in, trade your way to freedom. Maybe. But all I'm saying is, I don't want to get all, day trade hyperbole. What I'm saying is, right now, it makes a lot of sense to take your day trading window and shrink it to about an hour a day. So I'm going to talk about that hour a day. I'm going to talk about the kind of trades that we're doing in that hour and an hour a day. And this is a gear we shifted to, really kind of full time, meaning that's where my focus was since mid-June when things really got tough. And day trading continues to work, and we'll talk about that tomorrow. So that's at simplertrading.com/money. All right. So Zion Spears kicking it off with XLF. All right. XLF is going to suffer a lot of the same things that the Dow and the S&P are, because remember that financials are heavily weighted within both the S&P and the Dow. They're at the 200 right now, so that's kind of interesting. And the question is, can we look at the daily? What would be a solid confirmation for a potential short? All right, let me get the look at the charts there. Okay, now I can see everything. Cool. All right, what would be a solid confirmation for a potential short? All right. Neutral market trend. Are we at price-based resistance? 200. The 200 is there, so that's absolutely something to watch. I would love to see maybe 34.90 in a gap close, and that would likely pull up our volume to the mean, which is where we have exhaustion from before. So really in this area between, I'd say, the 200 and the gap close, and anywhere between where we are now and the mean of the V-score, that would be a solid exhaustion. Now, let's say you're using some of my other tools like the slow stochastic. Those do not. So I think a lot of folks are wondering, Rog, if you're intraday trading with volume, what does that mean for the HPMR? Are you kidding? Of course I'm using them both. Time, volatility, volume. Those are the three things that most traders are missing when they're just focusing on price. So if you have the slow stochastic, you'd love to see an overbought signal here. And since we have our V-score and our 200 propulsion, those are all the reasons we stack for the Y. And that's what I'd look at, Zion Spear. Good stuff. All right, Kevin Rose, glad I'm feeling better. I don't know that I sound any better, but I do feel a whole lot better than I did a week ago. This is true. So VZ, double red. Yeah, we've seen some telecommunications, really ugly action in the IYZ. Going into the wave, V-score volume resistance. And what we're doing when we combine the wave and, say, Darvis, or the wave and propulsion, those are both price-based. When you add, as you did, the V-score, Kevin, now I'm taking price and I'm adding another dimension, and that's that volume. Yes, that's a short. That's a short. We got earnings in the rearview mirror. That would be a short. I would also, Kevin, I would also just mention, you want to take a look at IYZ. And remember that if IYZ starts to rally, it might pull VZ with it. So make sure you're looking at the best example of a downtrend in that group. And that's where I'll pull up the multi-chart and do a scan and make sure this is the best looking downtrend, but darn good looking downtrend and excellent looking setup. So good eye, Kevin. Good stuff. Next question is, what's the name of the NR4 inside day indicator I use on TradingView? I am not right now, Prince. No, I'm testing some things in-house with the bot. So I'm not using anything like that on TradingView right now. All right, next up, what's a price that I would suggest a pullback in Apple? Okay. So editor, I know I'm splitting hairs here, but pullback to me is terminology that I would use specifically in the context of a trend. And I don't have that on Apple. Retracement might be a better word, because then that lines us up with Fibonacci retracement or some sort of retrace to a volume level, etc. So pullback would be you're thinking to the long side, right? I would be fine with focusing on, tell you what, that 145, 146 level looks very good. And I'd like to see us pull back to the -1 standard deviation of the V-score. And this is really where, even on top of this, think about, do we have an oversold stochastic? Think about if you're a fan of Fibonacci, is there any meaning to the pullback level in that area? It does. You had a 50%, which is my favorite of all the Fibo levels. My second favorite, the 618. So between the 50% and the 618, we've got a zone between 146 and say 143.35. And I'd look for something like that. So we got a price-based reason. We've got our volume. We've got a V-score. That's what I'd look for. That is what I'd look for. Now, remember, you've got ex-dividend date coming up. And usually after that, you'll see a little bit of a run-up in front of ex-dividend date. And then there's sometimes a little bit of a pullback after that. And we might be able to capitalize. Timing-wise, that would be a good way to look at the pullback. All right, next up, Robert. Now, what level would a pullback in XLE be viable? Now, this is a trend. So pullback conversations here, absolutely valid. Now, we might pull a 50% on this and say, wow, that's a long way to go. Another nice last major move right in here. 84.80 as a Fibonacci level. The 21 exponential is sitting at 84.20. And if I were looking for something more substantial as a pullback, where do we end up? Back at a +1 standard deviation on the V-score. And then also throw the wave up there. Where do we pull back in terms of the wave? And it's not a matter of which is best. Think about which are overlapping. And then think about the levels as a comparison of aggressive, moderate, and conservative, right? Think about separating it out in that way. So we're thinking more about scaling into positions versus just finding that one magical unicorn of a level in which we just kind of push all the chips to the center of the table. What is a zone that we can scale in at and control risk? And that's the way I'd build that zone up, Robert. All right, next up, Rich asks, do I think Tesla calls? All right, I think Tesla calls would be a good buy for a swing trade today. Okay. This isn't a downtrend, so I cannot yet start thinking about calls, but let me give you a scenario that could play out. We're just kind of mocking out what a 1, 2, 3 would look like. Now, we've already done this on the S&P. So we have a lower low, swing high. We need a retracement, and then we need to take out that swing high. And that would be through basically 234. If we can do that, we need to pull back and then come back at that 234 level again. And here's the most important part. We need to be in more of a neutral underlying market trend. We need to see our market trend go yellow again, because I can't buy in a double red. Now, there have been times that I've been tempted, and they'll usually be on some sort of shift in conversation, news about the symbol, or actually not or and a specific pattern that arises. Because here's something interesting. A lot of you are going to learn this on Saturday. How many of you are already signed up for Saturday? Just out of curiosity. Already signed up. And if not, definitely check out the webinar tonight, because the way that we did the two webinars is they're a completely new set of slides, completely new chart examples. A lot of traders asked, "Hey, Rog, you know, the first part of the year, we were still plugging away with the daily time frames. We were for about 6 months. Come June, that's when I started taking losses." Now, I knew the beginning of the year was going to be difficult. We knew that because why? The end of last year, we knew we were going to be embarking on a rate tightening cycle. We knew that rates were going to go up at some point in 2022. And equities don't like that, obviously. And so all those beautiful trends of 2020 and most of 2021 just fell to pieces. But we were still able to trade, in this case, to the downside. But like I said, at some point this year, I realized that I wasn't using the very tools that I have in my toolkit to manage, because for a couple of years, it's really, really easy to buy the dip, really easy to buy everything. So then it's amazing how often we forget about the things that we have and take for granted. And 1, 2, 3 patterns, looking at volume bottoms before I start looking for trend shifts. These were things I had to reincorporate. And really the idea here is in the thing that I learned in '08, I learned a huge thing. I'll never go flat again. I will never panic, sell, go flat again. I'll never do that, because there's always opportunity somewhere. There's always flow. Earlier this year, what was a big aha? I will never not look at where those volume levels are before I start looking for trend changes. Because for a while, I could get away with being a little more lax about setups. I think a lot of us were able to do that. I'm no different. 30 years in, we all can get a little complacent. And I think for a lot of us, that adjustment is, well, what do I need to get that clarity? And that's definitely where I look at something like Tesla. What do I need to get the clarity? First step is there. Let's say we assume that volume bottom support. Now I need the trend to cooperate. Then I need the pattern. Volume, trend, price. I don't have that yet, but that's the process I'm looking at. All right. So not today. And I can't short yet. I'm sorry, I can't buy. I can only short right now. Darius says being shook is an understatement. Yeah, I mean, I think a lot of traders in my position want to make it sound as if every market is easy. They're not. They're not. And I think sometimes the biggest adjustment isn't, how do I trade this daily time frame? But rather, maybe the better opportunities are on a weekly. We have 4 positions we built in the Sector Secrets Mastery, built on the weekly. All 4 are doing pretty darn good, pretty darn well. And then we shifted to the daily. We've been almost only day trading since mid-June. And I'm talking day trading anywhere from 2 to 6 trades per day, every morning in that little window. So it's not as if we're not getting opportunities. We absolutely are. And I was telling the group yesterday, I said, if anything, the testament to having a process is pretty much all last week, I had anywhere between a 99 and 100-degree fever, and I just really wasn't feeling well. So I only traded 1 hour a day in that 1 hour. By the way, 9:20 to 10:35. I'm not holding that a secret. 9:20, I start paying attention. The bell rings at 9:30, 10:35, pencils down, right? And in that window, we were able to be very, very productive, and I could work around feeling so sick. And that's another thing that day trading is great for. Day trading, you might say, okay, Rog, if we can do so well in that 1 hour, why not day trade all morning? That's the rub. More is not better. Better is better, right? Finding those edges at certain windows, time windows of the day, That made the difference. Not thinking, well, if I could do that well in that 1 hour and 5 minute window, what if I just went ahead and day traded all day? I'll just, 7x what I can do. No. In fact, if anything, it works the opposite, right? So I'm with you. And then we got shook, we shortened the time frame. So I love the alliteration there. When you get shook, shorten the time frame. Good stuff. All right, gang. As far as where can you find the webinar, Brenda, you can find it on the Simpler Trading YouTube channel, probably where you are right now, the Simpler Trading YouTube channel. And you can do that. And then, Prince, you're right. If you can start, traders who started trading during the tech bubble, right? Oh my gosh, this day trading is so great. It's so easy. Trading is so easy. Where are they now? Traders who said, oh, 2020, this is day trading. This is so great. This is so easy, right? Those of you that are here know we'll get wonderful years like that. But the rest of the time, we're going to get things that look a whole lot more like the end of 2021 and even 2022. This is not an unusual year, although the volatility is pretty extreme. This is sort of what happens normally when we have transitions in central bank policy. Do you think you're going to go through a few of these cycles of loose monetary policy, pause, tight monetary policy? Absolutely. And if you can adapt to that, to your point, Prince, there's nothing you can't trade. But a lot of that's going to be contingent on when certain time frames that you are used to trading get difficult. You don't persist. I call it a double mule, twice as stubborn, half as smart. You don't persist in forcing trades. You say, okay, where is the clarity? When you're shook, shorten the time frame. We'll be talking about that tomorrow. All right, gang, have a great one as always. Be good to each other. And I'll see you tomorrow for Charts and Coffee. Okay, gang. Be good to each other. Thanks for smashing that like button. Thanks for staying supportive in the room, staying positive. We're smarter when we are. I'll talk with you soon.